Cool. I'm Emiliano. Now I'm on Rentable, but I work in security for a lot of time, especially during the DeFi summer. And today I'm here for with this very good guys talking about insurance. So I don't want to speak too much about myself. So please introduce yourself, guys.
Hey everyone, Hugh Karp, I'm the founder of Nexus Mutual. I guess my quick background is I'm a traditional insurance person by training, an actuary. Got the DeFi crypto bug a while ago and kind of brought it together with Nexus. And we've been on mainnet since May 2019, and I guess trying to protect people in DeFi and crypto from a whole bunch of hacks. So yeah, that's the idea.
Hi, I'm Robert Forster, the director of Ease. We used to be Armor. I've been in crypto since 2017 full-time, a while before that. With Armor, we really set out to make every dollar in DeFi covered. We wanted to approach that through UX, through making coverage easier and cheaper to purchase. And eventually figured out we kind of needed to change the foundation of DeFi insurance to really do that correctly. So we rebranded to Ease. We came out with a new coverage model that's much better than any of these guys.
No shilling, please. No shilling.
We're trying to make insurance fun. We're gonna have a boxing match in Dubai, actually. But we took it back to where insurance was before insurance, where there were no middlemen risk pricing anything. If someone in a community had a loss, everyone else pitches in to pay that back. So we do that with DeFi tokens, with your yield-bearing tokens. If anyone in the ecosystem has a loss, our vaults will all be slashed a little bit to pay them back. Has a bunch of advantages that I'm sure I'll talk about more.
Sounds a lot like communism, but I'm Evert. I'm the co-founder of Sherlock. Sherlock has a unique approach to insurance. We're selling protocol to protocol, and we're using security experts to price the risk. This is basically fixing like two main points, like the user experience. So instead of a user going to a protocol and then going to another website to buy insurance, it's already baked in, so you can come and go. Another thing we're fixing is the pricing. So we're actually looking at the code we have a model for the pricing, so we have a good understanding of those risks. And I might have forgotten a little bit about myself there. So I'm a Solidity developer. I've been in Ethereum for since 2018, and started Sherlock last year together with Jack.
Hi everyone, I'm Dan Thompson, the CMO at Insurace. My personal background is a mixture between finance and hospitality, having run businesses across Europe for the past sort of decade. I joined the Insurace team a year ago, about a week before the mainnet launch, which was great. Lots to do, and it hasn't really stopped since. We now cover 140 different protocols across 20 different public chains. We've covered 350 million worth of assets to date, and it's growing at a great rate. We just brought out our V2 Light paper 2 weeks ago with some serious improvements on what we do. I've been in DeFi, in crypto really since about 2016, 2017, personally, but full-time since joining Insurace, coming in to head up marketing, business development, partnerships, integrations. It's a super exciting time to be in this space. It's great to be on a panel like this and great to have these conversations with these guys. It's such a growing space. I mean, last year was around 3 billion worth of hacks in the space. It's nice to see that there's actually a need for this space, new ideas, new big changes, Armor upgrading, and improvements to space that actually helps us or each other to actually make the space a lot safer for investors and stakers.
Hi. Yeah. My name is Kirill Ivanov. I'm a co-founder and tech lead of Bright Union. And I'm a techie, so I'm building for 20 years and building for blockchain for the last 6 years. So what we do at Bright Union, we're basically the decentralized insurance aggregator. So we aggregate all those guys, and if one of them says that they are better than others, so actually we are the one who you should ask, because and that's exactly our added value. So we try to provide the customers basically the best experience in choosing the best fit. So because you might hear later that they are all trying to solve the same, pretty much, similar issue, but in different ways. So some of them are better in something, some of them they're cheaper, some of them have better choice of their protocol. So when Dan's saying 120 protocols, we are above 200, simply because whatever they add, we are already, you can buy through us, so it doesn't matter. But so we are trying to explain what is the best choice for people to buy the cover to protect their funds, and they're making sure that they're secured. Apart from this, we are not only for the buyer, so it's not only if you want to buy the cover, you should or might come to us, but we also basically aggregating them in terms of the people, for the people who want to put money at work, so put money into insurance, decentralized insurance business, right, to start earning a yield from the sales. So we are doing that as well.
Cool. Thank you very much. You see, very, very expert here. So just to dive deep in the insurance industry and what are the needs. So I would like to ask you at first, but maybe we can extend the question also to other ones. So what are the, let's say, new and emerging risks in Web3, and why and how an insurance product can cover, can support users? Because maybe users that are hearing us don't know too much how they can use basically an insurance product.
Yeah, I mean, I guess there's a lot of emerging risks. I think every time we look around, there's something new popping up.
The most important.
Yeah. So, but I think the things that I kind of worry about now are kind of bridge risks. Mm-hmm. I think they're kind of honeypots, and the technology is still kind of proving itself or hardening at the moment. A kind of more up and coming one, perhaps layer 2 stuff. So, there's more adoption of layer 2 solutions coming out. Again, they can become like honeypots, and I guess some of the exit mechanisms haven't been tested fully yet, and there's some centralized components still. So those are the types of things I worry about a bit more. I guess a third category would be like interfaces, which I kind of describe which is kind of like a development team that are building on top of another protocol, another 2 protocols. They have to really understand exactly what they're integrating with, how they, like the edge cases of what they're integrating with. They kind of understand the basics. Yeah, if I deposit, that means deposit. But do I really understand all of the details about what that actually means in all scenarios? And so those are the types of risk areas that we're kind of, I guess, aware of and emerge. We think they're kind of emerging. I guess how can insurance kind of help that? I think it's at the end of the day, if you don't have good security practices, insurance can't solve the problem, because you kind of, insurance is there for more of the extreme risks. If you think about it, if the risk is still like reasonably high, for example, and you've got a new thing and it's got like a 20% chance of failure, well then the insurance price is going to be 20% or more a year. Mm-hmm. So insurance, like you can build a product that charges 20% a year, but is the user going to buy that? No. So like I think the insurance is really there for places where insurance practices are security practices are pretty good already, but you can never be sure. You never know if they're fully there. But I think for the really, like, there's kind of like bleeding edge and kind of obviously a scale of all of these things. And when does insurance kick in? It's definitely hard to tell. But I think the really early stuff, I think it's quite hard to insure at the right prices on a sustainable basis, because I think that's quite challenging.
Cool. I don't know, Robert.
Yeah. Can I add on to that? A funny scenario related to that. I agree that composability is going to be a huge thing. More and more contracts are going to be interacting with each other. Actually, with Armor, we were building on top of Nexus, and at one point, our contract, they made an update on their back end, and our contract broke because of that. And it required, thank God we had a good bug bounty up, because otherwise it just wouldn't have worked. No one would have noticed. It wasn't anything auditors could have caught. I guess live monitoring maybe could have caught it. But Yeah, I'm glad we had that. And those things are nearly impossible to risk, or to price the risk for. So obviously a model where you don't need to price risk too much. With ours, we don't charge premiums beforehand and essentially price risk based on how people get slashed. I think it's trying to price risk accurately in this industry is extremely hard, if not impossible.
Thank you. I don't know, Effort.
Yeah, I think it all boils down to smart contract risk. So even like the bridges are all smart contracts. So if you have like a good understanding of these contracts and you can, like mitigate some security issues and like the potential vulnerabilities, then you're able to make a good model also about the pricing and about the risk.
I mean, we're talking about an emerging market here, right? It's still a very, very young marketplace. Of course, there's going to be emerging risks. Everyone's pushing the boundaries. Every protocol, every team, every new concept, everything we've heard probably this week is, people trying new stuff. We're all bringing out new versions of our own apps. Then we're the ones who are following up on the industry. We're not the ones like creating the next technology for DeFi, for crypto. It is an emerging technology as a fundamental technology. It is still growing. It is still evolving. Metaverse, GameFi are all coming out. NFT technology, everything else is still evolving so much, and everyone's trying to do things in different ways. And there's so much money coming into the space that, of course, there's going to be vulnerabilities there. Of course, there's going to be opportunities for hackers to come in, and insurance is essentially chasing up, trying to figure out ways of making as much of that risk-free as possible, and not even risk-free, because hacks are almost like an essential evil in the space. You need it for development. As soon as a hack happens on one protocol, all the other developers, all the other auditors add that to their checklist to make sure it doesn't happen to them. Mm-hmm. So all we can do is then be that sort of final stop to actually make sure that some investors they have some sort of peace of mind. We can't cover everything. Wish we could, and maybe we will be able to one day. But it's all growing so fast. It really is just, the risk is inherent in the emerging technology.
Yeah, I totally agree that the huge risk currently is that cross-chain bridges. That's tech. I'm a technician. I discovered the code base and all the stuff behind them. It's in most of cases it's just so amateurish approach. That's just has nothing to do with decentralization. In most of cases, you have to trust the parties, etc., etc. The irony that my favorite one was which was the wormhole breach was hacked. That's actually proves another time that the risk is absolutely unknown in this industry. Everyone, if we treat someone as like Aave or someone like it's blue chip and it's secured, it's totally not. There is no single way. If you talk to any quant out there from the traditional insurance and you try to explain what the risks this or that protocol has, they all get crazy because they say they cannot measure risk like this. There is no history records, there are no simulations in most of cases, like Monte Carlo simulation. All this, I have the insurance and solvency background, so I pretty much know how the risks are counted. Most of these techniques are not applicable for DeFi at all. So long story short, just you need to buy the freaking cover in insurance. That's what we're doing, because that's perhaps the only way at this time to sleep tight.
Thank you. So try to look an insurance product from the both sides, from the user side and from a new protocol that would like to add the insurance to their application. So Robert, what do you think? That how user can choose a coverage, and how new developers, we have developers here at the hackathon that probably will be new founders for new protocols, how they can choose between the various products. What are the choices that they have?
I won't shill.
Please.
So maybe it's a better question for Sherlock regarding the developers, but us in particular, and maybe kind of almost dodging the question. I think insurance is moving in a direction where users shouldn't really have to choose. We're really trying to increase the use of coverage by making it essentially just built into what everyone's doing in DeFi. I know everyone on the team is essentially making it something where if you invest in DeFi, you can just check a box and get coverage for it. I think it'll soon become even more ingrained where either the protocol itself purchases coverage for users or the users are in tokens that are perpetually covered forever on that side. Obviously, if they want to choose between different current providers, Bright Union is probably the place to go. But yeah, hopefully it gets even better than that.
Thanks. Do you have the same idea, guys?
Yeah, so, sorry, what was the question again?
Yeah,
What is-
please. So the thing is how users can choose, an insurance product, and how, with me, with Rentable, I could have plenty of opportunity to, insure my product. Should I show to the user that they have some sort of choice? Should I not? And in that case, which are the products? So which are the models that they can use to integrate to an insurance product?
Yeah, that's I think it should be baked in, because as a user, you don't want to have the risk of losing all your funds, and as a user, you're not going to read all these smart contracts to assess the risk yourself. No single user is doing that. So by baking it into the protocol, you're basically insuring the user already. I think that makes a lot of sense. And also for teams, if you sell insurance to users and there is a hack happening, then 10% of your users are insured and the other 90% are not. So their 90% loses all their money and 10% is not losing their money. And that's a shitty situation to deal with, because how are you going to manage that? And if you sell to the protocol, maybe everyone is insured 50 cents on the dollar, and that's easier to deal with from my team's perspective.
Yeah, so for the audience, basically, the idea is to embed insurance in the product. User don't see that there is an insurance, but at the same time, if they don't choose, basically, we don't have this kind of situation where, some of the users are protected, some are not. So, the reputation of your protocol,
I don't see any reason why a user doesn't want to be covered. Maybe if it's someone super confident about the code, but there are not a lot of users that have that.
So do you guys believe all protocols in the future will be purchasing coverage for their users?
Yeah, I think they should be, because as all of you said, writing code is hard. E-bridges are super complex. So if you don't have insurance for your users, what are you going to tell when a hack occurs? Too bad. You should have bought insurance. I think that's just not the situation you want to be in. So ideally, if the space matures, everything will be insured. And I think that's the goal.
I don't know, you maybe want to say something?
Yeah, it sounds good and idyllic, but it's just not practical. Basically, there's nowhere near enough capacity to cover all of the risk. Nowhere near enough capacity. And not all users want to actually pay. If the yield is 5% and you want to pay a 2% price in insurance, some people want their 5% with the risk, and other people will want net 3. So there is a cost. And do you want to force users there, or do you want to provide them the choice? I mean, say all of Aave wanted to cover every single one of their users with an insurance protocol. That's just not practical. I don't know. What's the TVL? Several billions?
Several billions, yeah.
Yeah, I don't know what the number is, but the most amount of capacity we have between all of us right now would maybe be 150, maybe 200 million or something like that. So it's just right now it's just not practical. And it would mean that the insurance protocols would have to be 10 times bigger than everything else. So, I think ideally, yes, but I think there are practical considerations that it doesn't quite work like that in a lot of cases.
Mm-hmm. Thank you. So,
To that?
please. Yeah, absolutely.
Sorry, it's maybe shilling more, but I think there are also new models that can increase capacity like crazy. with a pure risk sharing models where we don't need underwriters, don't need them to deposit funds. Essentially, the supply of coverage grows with demand. It's very interesting to hear everyone hear all the different the views of how insurance will go, how it works, because it's so varied in this industry right now.
And you're anticipating, the next question. So, how could you scale? So, what are the challenges currently? Covering everything, but what are the practical methods that you can use, and which are models that can help to scale and theoretically cover everything?
Is that for me?
Well, I don't know who want to.
It's super easy. Our reciprocally covered asset model or uninsurance, I think, is the only way we can really scale that much. I know I've talked to you before, and essentially the thought is that we may not need to scale that much, that we can ensure what's most important. I'm not sure of any other models that would really allow us to scale that much. So
maybe Kirill, Dan, do you have some view about that?
I mean, the issue we're all trying to solve, and Hugh's nailed it on the head, is capacity. I mean, it's the reason we've looked at B2B on the protocol side as well. Actually getting enough capacity per protocol, figuring out a solution to the capacity issue is something that is vital to this industry to help it move along. I mean, we grow as an industry, as we build, and we're earning, and we're developing and coming up with new, more efficient capital models. But at the end of the day, the capacity issue is still a big one. We'd love to. We get requests pretty much every day now from big funds coming in wanting to cover amounts that are way beyond our capacity. We're sold out on certain protocols because they are so popular that we actually are always at the capacity. And even if we opened it up 20 times the current capacity, we'd sell out in a week. And capacity is one of the biggest challenges we face, not just us, I think everyone. And it's, it really is one of the biggest problems we have. And, we're working on different possible solutions, either looking at how we can actually upgrade the protocol itself, or how we can work with different partners, different DAOs, even traditional insurance companies to increase the capacity in some different ways. And that comes with its own challenges, everything from holding crypto, staking crypto, onboarding and offboarding, payments, KYC, full work. So there's a lot of different aspects to increasing the capacity in a sustainable way as well. Mm-hmm. That is a real challenge for all of us. We're all growing. It's it's emerging technology. We're all still almost chasing the back of DeFi off the back of this, but then to be thinking into the future and how we can solve these as well in a way that also, don't want to avoid regulation, but complies with any regulation that comes around in a safe way for us and for users. It's a big challenge, and it's a big undertaking that we've all got. Probably for the worst. We were having discussions about this earlier. We should have done any other industry within DeFi. It'd been great, but we were here doing insurance, and it's but for the right reasons.
Yeah, to add to that, so capacity is stopping now, right? So capacity, you can solve it indeed. Maybe you don't need so much capacity, but then you sacrifice the risk, right? That you can leverage up to what guys are planning to do, or whatever. Then you can less capacity might be sufficient. Capacity currently in decentralized insurance is super low. If you compare it to anyone out there from traditional world, even the biggest ones over there, but it's still whatever 600 mil or something. It's nothing, right? But and why it's not so much capacity? Because, as I said before, the risks are every potential investor, every fund that would like to put money in decentralized insurance, they have two questions: what my return is, which is a little bit. You can see that you can calculate that, and what the risks are. And again, as I said before, risks are quite unknown, right? So if you're a serious fund, you want to put few billion out there, you have to get the proper answer on what the risks are. Well, so I expect it will be improving, of course, because I think the risks. So these last 2 days of this event, right? You can see that how many teams out there are building some. The audits are better. The tooling is much better. The processes, the frameworks to assess the risks, even some are doing the frameworks around to measure the risks. So we are we are getting there slowly but steadily. So, but yeah, the capacity will go up definitely.
Thank you. So, do you think this is for you, Evert? Do you think that the more the protocols mature over the time, what's this can have impact on insurance products, maybe also on their prices or the evolution?
Yeah, good question. So if a protocol's code stays the same, so that they don't have any updates, don't have any new government proposals, and it's like as a high amount of TVL, like over time, like it becomes less risky, of course, but you assume like it's battle tested, hackers already took a look at it, so that like conceptually that lowers the risk. I think that answers the question, or?
Yeah. I would like to have your views. I don't know if you guys have any other similar view. Okay, please.
Sorry, I think there's two elements going on. One is exactly that the battle testing drops the risk over time, which makes sense. But then you've got the upgrade aspect, and I mean some protocols don't do that, but others do, and so I think when you come for a risk assessment, you're not actually just looking at like all this stuff we're talking about from a security point of view is all about tooling and all the rest of it and how good that stuff is, and great. But then you also have to kind of underwrite the whole team or the process by which the update happens, and can you do they have generally good security practices, because you're kind of trusting them to do that in the future as well. And how does the governance process work? Does the governance have a general community feeling that yes, we need to go and get formally verified or whatever the right tooling is before we release the next release? And so, so you've got one thing coming down, and then you've got another thing that's going up. And so, is that flat? Is it flat? Is it down? Is it up? I'm not really sure, but it's something to consider.
Okay, thank you. So the other challenge instead is, we started with Ethereum. Then we started to have, layer 2 sidechains and many other, we have an explosion of, ecosystem where we could be. And it's easy to be, let's say, in one of them, maybe in multiple instances of them. But what are the challenges for an insurance product to cover in a seamless way, also from a user perspective?
Yeah, I'll take a crack at that one. Just to give you an idea, Nexus covers stuff on any chain, but you can only buy cover. Like Nexus Mutual operates on Ethereum, but you can buy cover from Ethereum on risks on protocols running on other chains. And so there's kind of there's two things there. One that works, for high, proficient DeFi users that know what they're doing and flipping between chains and all this stuff. It obviously would be better if you were aware the customer was actually performing their core action, so you were available to buy cover on Polygon, Avalanche, or whatever other chain. And so I think there's two kind of things. One, it depends on your claims mechanism as well. If the claims mechanism is a smart contract-based mechanism that triggers stuff, then you actually need to be on the other chain. If it's claims voting like it is with Nexus, then you can do it without actually bridging. So there's kind of technical considerations and user considerations as well. I guess at the moment we're focusing on other things from a development perspective, and so we're sacrificing the UX of being able to buy cover on another chain and kind of saying, look, we offer cover, but you have to buy it on Ethereum. So,
okay, I see. What about you guys?
Yeah, I think L2s, maybe L1 is like the lowest chain risk. Like it never went down, it never passed. You have like some L2s that passed, for example. So like how do you go for like, is that insured or not? I think that's a question to talk about. But overall, like if you insure L2s, like are you also insuring the bridges in that case? So if you want to bridge it back, like if the bridge is hacked on L1 and the funds are gone from the bridge contract, like is that like an issue on L2 or L1? And I think like all these questions come up with these L2s. But overall, if L2s are just like EVM compatible and like just uses like the same EVM version as like layer 1, I think then it's the same concept that applies to both chains.
Thanks. Maybe then.
Yeah, I mean, so we're deployed on 4 different chains. We cover in the same way as Nexus, cover multiple different chains on top of that. As long as a wallet address can be proved to be owned, there's very little extra you kind of need to actually prove as an extra additional to the claim. The difficulty is there are now so many new chains coming out, so many new layer 1, so many new layer 2, so many new options to deploy. You've also got the issue of liquidity, providing enough tokens without diluting your tokens to create new tokens to bridge across to different chains, or whether it's even worth it, whether the demand is actually there. I mean, there are large ecosystems out there now paying different protocols huge amounts of money to develop onto them. Everything from Near, Harmony, even Carver's got a new development coming out. Neon is a brand new one that's just started throwing money at things. It's it's tempting to sort of want to develop on them, as tempting to want to go multi-chain, and multi-chain is the future, but it does add extra risks. It adds extra risks to us by having to bridge across. The user experience might not always be there. We've had some issues with Polygon over the last few months. It does create extra sort of hassle, but there are other benefits. So when Ethereum was extremely high in gas fees last year, having the option of Binance, Avalanche, and BNB chain now, Avalanche and Polygon as alternatives for users has actually proven to be extremely positive. But does that mean we should deploy to every single chain? No, there are inherent risks. There's not necessarily enough demand for people to use that. And at the end of the day, we get the comment that, from let's say a BSC project that you need to have all the capacity on BSC because our users only use BSC. The reality is everyone has, multiple wallets, right? In the space, is it really going to be that much of a hassle for them to use a different chain to purchase some coverage if they have to? Probably not. So there are both pros and cons to going multi-chain and developing on different chains. The difficulties are as soon as you get away from EVM chains to sort of, let's say, go into Rust, again, bridging across or just trying to find the demand and even just deploying the entire tech stack to an entire new chain to replicate, you're having to dedicate developer time, you're dedicating manpower to something that may or may not actually be worth it. And that's a risk in any protocol that's ever trying to evolve and grow. But it is a real challenge now when all this information is being thrown our way constantly, trying to filter through the noise and pick the right ones.
Yeah, well, I'm an Ethereum maximalist, so of course I believe only on mainnet and the rollups on top, so and nothing else. But we have hundreds of questions like this from potential buyers asking how the claim mechanism works, how can I prove the loss of funds in case of the hack happens, etc., etc. And you see, the guys here, they have all different answers. That's exactly why Bright Union exists, because we explain what you just heard. We try to explain to the buyer, so user can compare the different mechanism, how they would be submitting the claim in case of the financial loss. So I only believe in those which are based on cryptographic, right? So if you can prove that you have had access to the software address on that particular chain, or at least on EVM for sure. But some of the guys are selling like Avalanche covers, where it's a little bit questionable how you can prove that stuff there. Anyway, but no silver bullet here. So just different cases, different ways.
Yeah, and if I can add on a little bit, just about layer 2s in general, I think that is really where things are headed, that a lot of the use of different protocols are going to be on layer 2s. And at the moment, it may not make too much sense for development to be building specifically on there. But we definitely need to expand, and ideally, we can cover risk of the layer itself, of the blockchain itself, even if it's Ethereum. I know a lot of more traditional people are even worried about having funds on blockchain, period, rather than just on this protocol or that protocol. So we do plan, once we're diverse enough, to cover full blockchain risk for the layer 2s or even layer 1s.
Thanks. And moving to how insurances can help each other, what's your view about reinsurance? So basically, cover your back each other. and how it compares with traditional reinsurance, let's say.
Yes. Yeah, I think it's going to start. It'll happen. There is a question. There's a philosophical question about: do you go for reinsurance outside of the protocols? Like, do you go to the traditional markets because it actually gives you some diversification outside the blockchain DeFi industry, so it's less circular? I mean, obviously, I prefer not, because that's what I'd like. But that's an interesting point from a risk versus philosophical perspective. I mean, I would assume that. There will be reinsurance stuff coming up, but this kind of actually goes back to the general capacity type issue. You kind of need just generally to be able to increase the capacity overall, and I think that's just generally one of the market structure challenges with the types of risk we are covering at the moment. Like, a normal insurance company will cover people's cars or houses or whatever, but they cover individual small things, like lots of individual small things. Whereas here we're covering fewer number of very, very large potential losses. So we're covering catastrophic risks. And catastrophic risks in the real world, like wildfire or flood or hurricane or whatever, they have massive capacity issues themselves, just on a different scale to what we're dealing with in DeFi. So this is not a new problem within the insurance world. And I don't necessarily think, like, hopefully we have a silver bullet somewhere. I don't it's not as if people haven't been looking at this stuff for 100 years either. So I think it may be. I think we will be seeing some reinsurance between different protocols, but I also think that there will be a point where we may actually go outside at some stage to get reinsurance from traditional markets. And, philosophically, that's not really where I want to be, but it may actually help us progress forward.
Thanks.
Yeah, I think we're going to purchase some amount of reinsurance in the next week or so. With our system, we need to be adequately diverse, can't have vaults having too much capacity in one way or another, so we need a little bit of reinsurance. And agreed that eventually something off-chain, something more traditional is going to be extremely helpful. Again, with the full blockchain risk, we don't necessarily want... I always get the question of, well, if you guys are on blockchain, what if the blockchain goes down? How do you cover that? So hopefully there will be more talks there regarding how we can work together.
Yeah, basically it's all about, like, if the EVM risk, if you insure protocol to protocol and the EVM contains a bug, then like every protocol could be affected. So if you look for off-chain insurance, you can mitigate that risk also, and that's something in the future.
Yeah, completely agree. I mean, working together is the future. We've been having this talk this week about not necessarily this exact issue, but also about when it comes up to having to deal with regulators globally. A united front is a much better collaborative state to be, rather than competitive. Reinsurance, even on a protocol to protocol level, I think he's right again. The capacity issue is one, but as we all get to a level where we have sufficient capacity, there is a way of working together to. It's also the number of different protocols available for insurance as well. If it's just one or two, there may be a perceived conflict of interest in there somewhere for especially any governments on voting. However, with multiple options for reinsurance, there's at least it's a safety net in numbers rather than just having one DeFi insurance protocol reinsuring another.
Yeah, it's a no-brainer. I mean, the blockchain, all this composability of this financial Lego out there. The insurance is like a given, right? I mean, you don't have to do anything for that. If you want to launch your insurance product, you will definitely reuse some of the DeFi out there. So basically, guys making exactly like that. So they're trying to become the reinsurer in the space, right? So you might reuse some other, or we might actually. Okay, let me honest. So we are considering launching some insurance products, right? For that, we need a capital. If we want to launch that, we will definitely step on someone out there which has enough of capacity already that we can scale up. So it's a blockchain nature. So yeah, it's almost there.
Thanks. So in 30 seconds for each of you, what are you expecting in the upcoming months in the, let's say, insurance industry or in general in the security ecosystem?
I guess in terms of the insurance stuff, I think we're really at an inflection point. I think the users that mostly are using DeFi stuff now are very risk on, and so they need less insurance. But I think the mass adoption is actually going to really require it, and people are going to want it more. And so I think there's going to be a massive uptake of insurance coming with more institutional and more mass market adoption.
I think generally the way people think about insurance is going to fundamentally change with new updates happening, with new models that'll essentially, I feel every industry in blockchain kind of goes through its automated market maker moment where it stops emulating traditional reciprocals. I don't know what to say. Traditional industries and really adapting it to blockchain. So what we're trying to build is the DeFi native real blockchain insurance. And obviously, I think that's going to be much bigger. Chilling there.
Yeah, I hope to see more growth of like better security mindset among protocols. So like everyone develops more securely, growth of the DeFi ecosystem, and less hacks by the North Korean hacker groups. That would be great.
Thanks.
If I were Robert, I would say that InsureAce is going to take over the whole marketplace in the next few months. But we don't shill.
No, we don't.
No, I mean, no, it just comes back to, again, the rate of hacks is increasing. 2020 was 120 million, then up to 2.6 billion last year. We're already at around about a billion this year already. It's just growing, you know, that need for insurance, the money coming into the market, right, is growing and it's coming in, and they are facing their own challenges of regulation, onboarding, fiat to crypto and offboarding as well. As soon as the solutions really start to develop for that and the money comes in, people managing other people's money are going to be looking for ways to cover themselves and cover their clients' money. So I think it was the Messari end of year report that said 2022 is a great time to be an insurance salesman.
Cool.
Yeah, so in terms of decentralized insurance concept, right? So we are talking about insurance here, and its whole point is that about the code which replaces the organization, right? So that's cool. If you look, it has happened. Basically, if you see on the lineup here that everyone is covering the DeFi risks, right? So it's about rug pulls and hacks, stuff like that. And it's okay, it's been developed so far. What I expect personally is that there will be another aspect or another direction of the concept of decentralized insurance, which will not be about DeFi. It will be about something else. What exactly? I don't know. Perhaps, but it will be another angle of this concept, which will be applied and used with much bigger amounts, much bigger volume, and it will be just huge. Let's see.
Thank you. I think that we have run out of time, but I mean, it was a very interesting talk with, you know, amazing speakers. Someone is shilling, someone is not, but you know, it's still DeFi, you know. Cool. So maybe they during, you know, nightlife they, you know, hack something else, but anyway, so. Thank you a lot. I mean, it's going to be, you know, the outlook is very, you know, exciting from an insurance perspective and also from a security perspective. And I would say that I would do a big clap to all these guys.